Principal of Financial Innovation. I have the privilege to be here with actually two scientists that are the few of people that actually create the algorithms that are powering the future of finance. Sameena Shah, Managing Director and Research at JP Morgan, and Peng, that is the Head of Machine Learning Strategies. Welcome, Sameena, and the floor is yours.
Thank you very much, Antonio, for the introduction. Hello, everybody. It's a pleasure to join you, albeit virtually. It would have been even a greater pleasure to join you in person, but we'll see next year, hopefully. We'll be able to meet each other in person. Let me begin with, if you could just give me a hands up on whether you're able to see my slides. And okay, I do see my own slides, so we're good. Thank you for having us today. And as Antonio mentioned, I'm a managing director at JP Morgan, where I have dual roles, one as an AI research executive, and I'm also the client onboarding chief transformation officer. The views I'll express today are my own and not necessarily of my firm, but I do want to talk to you about what it takes to build AI technologies for enterprise scale and how firms can leverage AI to maximize the value you get out of it. With that, I'll pause just for a second for Peng to introduce himself, and then I'll jump into my section.
Okay, thank you very much, Sameena. My name is Peng Cheng, and I lead the Big Data and AI Strategies research team here at JP Morgan. So we're part of JP Morgan Global Research, where we are facing clients, which are asset managers, hedge funds, et cetera, on the buy side. And what we do is we basically leverage modern statistics techniques as well as alternative and traditional data to help our clients generate alpha and solve problems.
Okay, great. So I'll jump into my section first. So I've been an AI technologist and I've been working in the industry for a long time. And one of the things I noticed was, when we create technologies, often there could be people who are motivated by algorithmic side versus people who are more motivated by the problem side. So I coined this term, which I call task-centric AI. And the hypothesis there is that the task is actually the winner. It's not necessarily data. It's not necessarily algorithms. It's not necessarily the human expertise or the path that the humans have taken till now, but it is a convergence. And all of that convergence needs to come together and orchestrate in different ways to finally solve the purpose. And the purpose could be achieved in many different paths. And finally, the AI problem is a creativity problem in which we explore different paths to finally achieve the purpose in the best, most optimal manner. So I want to make the case for that, and I'll give you a couple of examples. So the first one, I want to talk about a use case, which is a little bit counterintuitive. It talks about when you have the same data, but a slightly different version of the problem statement, and how our approach and algorithms to solve that problem could lead to very different solutions. So this was a case that we had when early last year, we had a lot of interest from retail traders, and people in our firm started noticing that there was a lot of interest from retail traders, and we wanted to protect ourselves from a risk perspective. So the question was, how could we find in an automated way that people are, quote unquote, going to be rallying around certain stocks, and then could we put risk mitigation practices in place to protect the firm? So in general, if we think about how to look at Reddit or Twitter or social media content, one thinks about, we could put in some feeds to listen to those streams. We could infer sentiment, we could infer volume, and then come up with some indicators that could indicate to traders or to quants that, hey, these are the ones that seem to have the highest activity and the highest sentiment, things like that. Now, while extracting sentiment from microtext and from the lingo that is associated with Twitter and Reddit is a hard problem. It's not an impossible problem. And people have created algorithms that can do those things. So we first went with that version of our algorithm and our system, but then the challenge was that we needed to have risk mitigation in place by the time the indicator became solid enough or accurate enough for our quants and traders to be able to put risk mitigation in practice. So then we revised the problem statement to be that not only did we needed to know which are the potential stocks, but we also needed to have a leading indicator that allowed us to put this risk mitigation in practice. So just with this one word slight variation of leading indicator, then the problem becomes different. And then you start thinking, how can you get to a leading indicator? And then the problem becomes, you really have to think about human behavior. And you have to think about who are the key influencers that when start chiming in to those conversations or start saying things, one can estimate that the crowd is going to rally around them. So then the problem then becomes of a find the influencer problem as opposed to what the masses are saying, because by the time masses agree, we might already be too late. So then we revised our algorithm to be more in line with, find the leading indicators, and then alert, and our quant team helped us put in a prediction of short squeeze over those signals. And then our traders were able to put risk mitigation in practice very quickly. And this was one of the reasons cited why JP Morgan had won the Risk Magazine's House of the Year award, which was quite exciting for us to see. Now, I'll go on to a second use case, which is again a counterintuitive use case. So as you can see, I chose all the examples that, were counterintuitive. Maybe it's not, and then that would be a good conversation to have as well. So the other thing is people always think like, I cannot do AI because I don't have data. So I want to make the case for no, even if we don't have data, we can still do AI. And we'll talk about one use case. So and then before I jump into the use case, I also want to draw your attention to that if we think about AI broadly, one of the most famous ways of teaching AI is learning from data, which we often also call machine learning, but there are many different ways of learning. And we can train AI systems doing many different things like learning from instruction, learning from feedback, learning from imitation, learning from rules, and learning from reinforcement learning, like critics. So, and even within learning from data, there are many different approaches. Some of them use very little to no data. So it's a pretty broad spectrum of what we can train AI systems from, not just necessarily large amounts of label data per se. Because we could have like no label data, we could have only passive data, and many of those techniques could be quite useful depending on the task we have at hand. So one size doesn't fit all. So with that, I want to make a case for when there is no label data, then could we still learn? So one such example, which you may also find in your operating environment, is the case where the task is complex that humans are doing, and it may take vast amount of time for humans to actually label and state that this is the thing or aspect that typically a learning system would require. So one such case is, let's say we want to create a sophisticated AI engine that can understand text, it can understand what something means, and maybe for context, we also want that system to understand that, hey, this is a title, this is boldface, this has some meaning, this is where the section ends, this is where a new section begins. Hence, this is kind of information that's together, and this is information that's separate. This is the title. Title usually contains a punchline, which the rest of the paragraph is talking about. And we want to feed all of that information to AI system. Now, the challenge, of course, is titles could be written in many different ways. Segments could be written in many different ways. Documents come in many shapes and sizes. So how do we tell a system? One approach is we could hire lots and lots of humans, and they could keep like marking out boundaries for sections, for titles, headers, footers, which is very boring task. Nobody wants to do those things. And it was also very time consuming. So the idea was, could we use completely synthetic documents and synthetic labels? So what my members in my team did was that these documents could also be generated by AI. And if we are generating documents, which AI can do today, and we also parameterize and say, hey, put a section or put a title, put a footer in this specific location, we automatically know what is the accurate segment, section, phrasing for that document that we are generating. So it's kind of a counterintuitive idea that we first parameterize all the aspects of a document like header, title, section noting, footer, tables, charts, diagrams, pictures, and then we generate a number of documents based on those. And since we are generating all of these aspects, we know exactly what is placed where. Then once we generate lots and lots of documents like this, and we know that this is where each of these aspects is, we use those as label data to then test on new and real functions that NLP or AI actually has to do. So in this case, since our machine is automatically generating different, like sections in the documents, phrasing, all of these are controlled by machine, and you can make them as diverse as your use case requires. You can even make it a different language. You could even make it different colors. You could even make it noisy of what could be like true representation of documents that you actually get in real life in your enterprise. Sometimes people send scans, sometimes images have like a bleed through. So all of these things can also be part of the parameters we give to AI. And then it could be also very different type of document type. These need not be articles. These could be forms. These could be different types of resumes. It could be articles. It could be anything that your task requires. So once we have trained this, once we have generated, once we have captured the labeled from these completely synthetic documents, nothing to do with the actual task, then we use those to test on real documents. So in this case, these are real results of what we found on real documents after we had trained on synthetic documents. And we found that there was negligible difference between human labeled and real documents versus completely synthetically generated by AI documents and completely synthetically labeled, which is very, very powerful and counterintuitive that you could create AI systems as effective based simply on synthetic documents and synthetic labels. I'll pause for reflections, and if there are no immediate questions, I'll pass it on to Peng by wrapping it up and saying that finally the AI value in enterprises is a task value, because that's what finally our organizations are doing. We are solving tasks. Our human cognitive tasks need to be solved by bringing different algorithms together, orchestration of algorithms, human domain expertise that we need to capture, and the tech stack. And once we add data, of course, and with data may be or may not be there, we need to explore for different use cases. But once we bring that and go after the task, then we can achieve the maximal value from whatever the use case we are trying to achieve it for. And with that, I'll pass it on to Peng.
Thank you very much, Sameena.
Thank you, Sameena. Yeah, so I will share my screen here. And I have my presentation as well. So I will just put it onto the full screen. So from my perspective, I will discuss where we apply AI for investing from 3 different areas. So in terms of the signal generation, risk forecasting, and portfolio optimization, and with one use case in each criteria, then hopefully you can see there are broad applications of AI in the life cycle of the investment process. So first, let's talk about signal generation. And I would say that in this area, the overwhelming dominant development has been natural language processing. And that has basically revolutionized how we look at unstructured text documents. So at JP Morgan Research, we have our own proprietary NLP engine. We call it the Smart Buzz. It is based on an open source Google NLP engine called BERT. However, we train this NLP engine on JP Morgan proprietary data, which are basically JP Morgan research reports over the last 10 years. So there are over 1 million JP Morgan research reports written by our analysts. And we continue to update this NLP engine every 3 months. And what are the advantages of using JP Morgan proprietary data for training the existing NLP engine? I think one of the biggest advantages is that it makes this NLP engine domain specific, so that when the engine looks at a word, simply something like OW, it knows that it means overweight, and it means a positive term to buy, as opposed to describing, someone's body, right? UW, underweight, so it's a bearish term. Or Apple is associated with iPhone and not some fruit. So that is one of the biggest advantages. And secondly, labeling is a huge challenge as well, because it always involves human participation in labeling the document, whether something is positive or negative. But with JP Morgan Research reports, actually, we have already expert level labeling from JP Morgan analysts, because in a lot of these reports, it's already been labeled an overweight report or underweight report. So we know that, okay, words that appear in an overweight report probably tends to be more positive, and vice versa for the ones that are labeled underweight. So, that makes us very, very happy with our Smart Buzz engine. And therefore, as you can imagine, there are a bunch of things you can do with it. But I will just show you one example, which is analyzing earnings call transcripts, the sentiment within it, and then what kind of alpha can be generated. So basically, the chart on the left shows you the performance of stocks, where we classify them as positive on earnings day based on the earnings call transcript, or negative earnings call transcript. And basically, as you can see, if we go long the stocks that have positive earnings call transcript and go short the stocks with negative ones, then after 10 days, we'll see a performance spread of 95 basis points between the two cohorts. So, it's quite a statistically and economically significant number. And if you incorporate the Q&A section of the earnings call transcript as well, whereas, previously we've only included management discussion, right? Then the information content is even greater, so that after 10 days, the more positive companies outperform the negative companies by 177 basis points. And this, as you can imagine, can be applied to companies around the world. And we do find globally, there's significance in analyzing earnings call transcripts. And of course, it doesn't stop there. Like, there are different types of corpuses that we can analyze. We can analyze not only the earnings call transcript, but also company news, social media sentiment, as Sameena described. But actually, one of the highest demanded item from our clients is analyzing Fed minutes or central bank press conferences, because as we all know, recently the messages sent by central bank has been the main driver of market directions. So people are very interested in seeing the same analysis applied to central bank messages as well, and that is something that we're working on. And we make this available to clients in an interactive format. So you can go onto JP Morgan Research website, and then you'll be able to put in paragraphs of up to 30,000 characters, and we'll analyze the sentiment for you. So you can paste in earnings call transcripts in real time into our NLP engine, and then we'll be able to tell you a score between +1 and -1, whether this paragraph is positive or negative sentiment. But we also go down to the sentence level, where you can see in each and every sentence, what are the what sentences make this paragraph positive, what sentences make this paragraph negative. So it's a very, very intuitive and interpretable NLP engine. So that's basically what we found to be the most effective application of machine learning and AI in alpha generation, in signal generation, largely natural language processing. And then we move on to risk forecasting. And over here, actually, I describe a case of volatility forecasting. And I actually think that in terms of machine learning techniques, forecasting volatility and risk is actually the more natural application. And we have done that in this specific case by identifying volatility regimes. And when we talk about volatility regimes, we tend to talk about, okay, the market is in a high vol regime or a low vol regime, right? But what we found is if we apply machine learning techniques to the VIX, we will be able to identify 3 regimes, low, medium, and high. So we find that VIX is in a low vol regime when it is below 15. When it's between 15 and 21, it is in the medium vol regime. And when it's above 21, it is in a high vol regime. So how do we arrive at these boundaries? We apply a hidden Markov model to the time series of the VIX. And basically, we're able to decompose the distribution of the VIX levels into a mixture of 3 log normal distributions, as you can see on the right. So in other words, from one big distribution, we're able to, based on time series information as well as the level information, back out 3 separate groups where VIX behaves differently. And and as you can see on the left, here's the regime classification of VIX over the long run. And as you can imagine, over the last year and a half, VIX has stayed in the high volatility regime. So maybe you'll say, well, that's pretty obvious. I can look at the VIX and I will see, where VIX is, right? And I can tell you if it's a high vol or low vol regime, what's the value in this? So I would say that a lot of the value come from, where determining the boundaries. If VIX is at 21 or 22, is it in a high vol regime or is it in a low vol regime? So that's what the model will tell you. And then, what are the applications of regime identification? First of all, it is for risk management, right? Because you may want to allocate to safer assets when volatility is high and, more aggressive assets when volatility is low. It also tells you about liquidity conditions because volatility is one of the biggest input variables into market makers' liquidity provision model. So in high volatility regime, we generally find poor liquidity, and in low volatility regime, we find good liquidity. And finally, it informs about strategy performance. So here I said volatility strategy performance. So actually counterintuitively, in high vol regimes, long volatility strategies outperform, and in low vol regimes, short volatility strategy outperform. Okay, but actually it can be applied to a broader set of strategies. And because as I just mentioned, in high vol regimes, liquidity conditions tends to be poor. So strategies which supply liquidity to the market in high vol regimes produces excessive economic returns, whereas they do not when liquidity is high and volatility is low. So we've done extensive studies on this and found strong empirical evidence. And lastly, applications of AI can also be found in portfolio construction and optimization as well. So over here, I would just use one example, which is when applied to a hierarchical risk parity portfolio. So risk parity portfolio, as you know, are basically portfolios that allocate to assets based on the inverse of their volatility, right? However, in this simplistic version, correlation is not taken into account. So let's say if I have a portfolio of 3 assets, equities, government bond, and investment corporate bond, it's not appropriate to simply calculate their volatility and allocate according to the inverse of their volatility. Because government bond and investment corporate bonds are highly correlated. So if you do that without consideration of correlation, you're likely to over-allocate to these two asset classes versus equity. What hierarchical risk parity does is that it accounts for the correlation between groups. So let's say, it will see corporate bonds and government bonds have a high correlation, and therefore first allocate in a risk parity scheme within this group, and then allocate between equities and this fixed income group as two assets. So over here, of course, the question is, how do we identify the groupings? Generally speaking, in equities, or even in, let's say, corporate bonds, what we would do is simply look at, let's say, sector classification. But actually, sector classification, when you think about it, is quite an arbitrary determination. A lot of times, what we find is that companies in very, very different sector groups can behave very, very similarly. Let me give you an example. So in the US, technology companies in the last decade has done extremely well, right? I mean, just to name a few things like Netflix, Meta, et cetera, right? In Europe, however, there's been an absence of technology companies. But we found that luxury goods companies exhibit the same kind of risk and return characteristics, or very similar risk and return characteristics as technology companies. So Louis Vuitton, Kering, for example, behave very similarly to Netflix throughout market conditions, okay? And they belong to totally different sectors and regions. But what we do is when we apply machine learning techniques to group these stocks agnostically and then apply hierarchical risk parity, what we find is that the performance of the portfolios, of the resulting portfolios, is almost universally stronger than if we use sectors as a classification. And that is basically what is shown in the lower bar charts. The black bar is the Sharpe ratio of a hierarchical risk performance, hierarchical risk parity portfolio based on sectors. And the blue bars are all of the other machine learning based clustering techniques. And you can see that almost universally, machine learning outperforms traditional sector classification. So, that's just a very, very simple example of how machine learning is applied in portfolio construction. So overall, to summarize, machine learning and AI applications can be found throughout the life cycles of portfolio management, from signal generation to risk forecasting to portfolio construction. And I haven't even got to analysis of market microstructure or execution, where it's a very active area as well. So, we think there's huge potential in machine learning, in AI, in finance, and we'll continue to dedicate effort and resources into, helping our clients deploying these techniques in their investment process.
Thank you very, very much. Sameena, I would like to ask you about what are your take on future generation AI? For example, we are seeing like the first commercial application of this natural language processing, and then we are starting with all this fashion of generating like images. So what to expect next? What do you think the next generation AI will look like?
I think in some ways, we have been on this journey for a while. I think if we look at the cognitive kind of spectrum of the tasks that AI could do, which were more rule-based. So rule-based on one side of the spectrum and highly cognitive tasks and decision-making on the right end of the spectrum. I think slowly, and maybe like sometimes with bursts or jumps, AI has been taking more and more of the work that humans have been doing and changing the nature of the work. And I think that trend will continue. I think in terms of change, what we are seeing now is one, that there need to be a convergence between symbolic methods, which capture human expertise, domain expertise, how something needs to happen with controls. So all of those constraints need to be part of the equation, plus the sophistication of the algorithms. And I think those two sides will come together to make these methods in conjunction even more useful for enterprise applications. So I think that's another. I think this constraint about data, I think with synthetic data, gets mitigated quite a bit, which is an exciting kind of innovation. I think that will unleash a number of use cases that were previously unreachable. A lot of the synthetic data use cases are also, to your point, in images and vision and documents, also in PII types of things in which we previously couldn't operate because it was really private information. But now I think with the advent of synthetic data, it can be created and one can explore more methods and more use cases in those spaces also. For example, one of the things I think, Amazon Go uses, or, in capturing how a person is picking up some object from their grocery stores, that type of, label data or that type of data, nobody could actually create that, hey, you now pose in this particular way, or now you approach in this particular way. Like, it's not even like cognitively possible. So those tasks we were previously thinking are highly cognitive tasks, and we cannot teach AI. But now what happens is that we can curate these data sets in a way that we want and teach AI to now do those use cases also with high enough accuracy that were previously not possible. I think with the advent of large language models, and as Peng was also saying, what has also happened is that we have come above the threshold for what is acceptable from an accuracy and risk acceptance perspective. So I think those types of tasks will become more and more automated as well. And I think finally, the aspect around fairness and bias, I think there's a lot of great conversation and new methods that are coming in. And we also work quite a bit in those areas. I think those will also enable a lot of use cases to, one, ensure robustness of AI across a number of different test cases, and also from a bias and legal perspective, prove that these methods are actually fair or fairer than what we have been doing as humans.
Thank you very much. And I have a very technical question, to Peng, about the feature engineering and the problems of applying this to financial time series. And because I think machine learning is we can sort of do a reverse engineering to detect the pattern, and we already know the output. I think that's the challenge in financial time series, because sometimes we didn't know the output, and we don't know how to label that data. How you are starting to solving that kind of problems, Peng?
You mean how to avoid overfitting, or avoid prior beliefs contaminating the data? Is that your question?
Yes, and more related about the special treatment of financial time series, because it's not working, for example, with other kind of data that we have, in other industries, detecting, I don't know, consumer patterns or things like that.
Okay, understood. Yeah, so financial time series. So as I said, generally speaking, there are different types of financial time series, and existing machine learning models and architectures tend to work well with time series that exhibit strong memory. So that means basically volatility and risk. So, generally speaking, we find, as I mentioned, we actually find that existing architectures in, neural network, deep learning, work extremely well with volatility forecasting. So that's one part. And then secondly, what about all these other time series, right? In terms of returns, then over there you will have to be very, very careful, because as Sameena said, actually, there's not that much data in terms of return time series. If you think about even the S&P itself, if you just look at the daily returns going back, maybe about 80 years is available, but that pales in comparison to, kind of data that is available to, let's say, technology companies. Okay, so over there, I think generally speaking, you need models that are relatively less data intensive, or you have to have very good prior in your modeling to make sure that you don't overfit. So that's kind of what I would say now. And then moving on to the third type of data, which is higher frequency data. Then over there, things change a little bit again, because when you go to the intraday level, then generally speaking, fundamentals don't change as much. So you actually go from an open system where you have all this news, all this fundamental information, to a more closed system where only supply and demand drives the price action. So over there, actually, machine learning becomes more applicable again. So we've seen pretty active applications of machine learning on tick level data, order book data. So yeah, I think just in short, the answer is depending on what time series you have to choose the right architecture. And a lot of times, maybe it's machine learning is not a good fit for some of this data, then don't force yourself to use machine learning methods.
Thank you. We are running short of time, and there is a question from the audience, Jose Manuel.
I have 3 questions, but I will be very, very short on all of them. The first one is what is the potential use of synthetic data in order to make available to the public or to the researchers or to the firms data that is confidential from the central banks? This is one option that we are exploring, and I would like to know your opinion. The second one is what is the performance of these use cases that you are doing compared with techniques from quantum analytics that could improve some of the results? That is, how do you see the competence between artificial intelligence and quantum computing? And the third one is most of the cases that you mentioned has not this problem, but some use cases, like for example credit scoring, have problems with GDPR requirements and so on, and most of the problems are related with the interpretability of these models. Then what is your assessment of the interpretability techniques for machine learning?
I can take those. So for your first question, absolutely. And I think that is one of our motivations also, that we did find that there is a gap between external academic research and being applied to financial problems. So many of the synthetic data sets that we are generating that have nothing to do with the real data or real customer data, I should say, we are actually exposing for external use. So if there is a need, please reach out to me. There are some that we have already open sourced, and we have the ability to share. And if others, like we do collect, like if there is a more interest from the open science community and research community to work on certain problems. And we have also published our paper in top AI journals and conferences. So some of the techniques also we have open sourced, and as part of that medium for other people to build on that science. To your second question was around, it was PII data, right? For GDPR concerns and things like that. Sorry, I didn't take notes.
The second one is on quantum
quantum,
computing.
Yes. Yeah, that was a hard question. So I was trying to, cleverly jump over it. But you caught me. Just kidding. So quantum, yes, absolutely. So we do have actually people in our group who do work with quantum researchers as well. And there is it's more from, I think, NLP, some of the techniques people are now trying to deploy on quantum computers and things like that. It's early days. I think for now, my job is safe. AI is here to stay. So I'm not becoming a quantum researcher in the next 5 years. But I think, there is definitely convergence of technologies, which we should be cognizant about. I think also there are very exciting developments in the technology area. And usually the convergence of these technologies do unleash the next wave. So that, is definitely something we are also thinking about. And then PII, absolutely. I think that is also where synthetic data can absolutely help. And I think from also a fairness and bias perspective, the other kind of thing that we are also working towards is if that could be based as part of the optimization function and parameters to then generate data that actually mitigates bias in the data itself, and then later helps the algorithms and the output performance also. So now we are also trying to establish back that loop, which I think will be an exciting paradigm to go after, because it is often hard to change human behavior. And I think my personal opinion is it is easier to change AI algorithms. So if we can do that, I think that will also enable better decision making in future and standardization.
Thank you very much. Sadly, we ran out of time, and it was a pleasure to have this conversation with both of you.
Thank
Thank
you.
you.